Welcome to The Explainer. Today, we're going to break down one of the most vital tools for understanding a company's real health, the statement of cash flows.
Okay, let's kick things off with a really important question, one that gets right to the heart of why this statement even exists. You see a company posting massive profits, but does that actually mean it's in good financial shape?
And the answer, which might surprise you, is a big yes. A company can absolutely be profitable on paper and still go bankrupt. It all comes down to the difference between reporting a profit and having actual cash in the bank to pay your bills. That's the real story the statement of cash flows tells.
All right, so to really understand the statement, we first got to get the language right. We're going to use the official definitions from the accounting standard, IAS 7, and it all starts with three key terms.
First up, cash. This one's the easy part. It's exactly what it sounds like, the physical money a company has on hand and the funds it can access immediately from its bank accounts. No strings attached, just pure, ready-to-use cash. Then you've got cash equivalents. Think of these as cash's best friend. They're not quite cash, but they're super close. We're talking about very safe, short-term investments, usually stuff that matures in 3 months or less, that can be converted into a specific amount of cash in a flash. And that brings us to cash flows. This is the core concept. It's simply the movement of that cash and those cash equivalents in and out of the business over a period of time. It is literally the financial pulse of the company.
Now, the real power of this statement is how it organizes all those cash flows. It doesn't just give you one big number. It breaks everything down into 3 distinct categories that, together, build a complete financial picture.
So you've got operating, investing, and financing. Each one of these tells a different chapter of the company's story. They answer 3 fundamental questions. How's the core business doing? How's the company building for the future? And how is it paying for everything? First, operating activities. This is the lifeblood of the business, the cash that's generated from what the company actually does. The personal analogy is perfect. It's like your salary coming in minus all the cash you spend on your daily living expenses. This is the engine room of cash generation.
And here's why this is so important. We're talking about actual cash. This isn't about sales made on credit that you'll get paid for later. It's about money received. It's not about future bills, but about cash that's already been paid to suppliers and employees. This is ground truth. Next up, investing activities. This section shows you a company's ambition. It tells you how it's spending cash today to hopefully grow and make more money tomorrow. Is it buying new property, upgrading its equipment? This is where you see its long-term strategy in action.
You can read so much into these numbers. A big cash outflow for new equipment could signal aggressive expansion. But a large cash inflow from selling assets, well, that might mean the company's streamlining or maybe even struggling. Every number here tells a crucial part of the strategic story.
And finally, we have financing activities. This tracks the flow of cash between a company, its owners, and its lenders. It's all about how the company is raising capital and paying it back. Think taking out a new loan, issuing more stock, or paying dividends to shareholders.
This section really reveals how a company is funding everything else. Is it taking on more debt? Is it bringing in more cash from investors? Or is it paying them back? The answers are absolutely key to understanding its financial stability and its overall structure.
Okay, let's tackle one of the more nuanced parts of IAS 7, where there isn't one single, simple answer. This is an area that really requires careful attention, especially when you're comparing different companies.
So where do interest and dividends get classified? This is a super common point of confusion, and that's because the standard actually allows for some flexibility. Why? Well, because you can make a really good argument for classifying these items in different ways depending on your perspective. Just take a look. For something like interest paid, you could argue it's just a day-to-day operating cost. But you could also say it's a cost of financing. The standard says either can be right. The most important rule, though, is consistency. Whichever path a company chooses, it has to stick with it year after year.
Okay, so we've broken it all down into its component parts. Let's zoom out. Why go through all this trouble? Because this statement is an incredibly valuable tool for making smart economic decisions. Ultimately, understanding a company's cash flow lets you see beyond the reported profit and get to the reality of its financial health. It helps you assess its ability to survive, to invest, to grow, and to pay its debts. It just cuts through all the accounting assumptions and shows you where the money really went.
And this is the final, powerful question the statement helps you answer. A company with strong operating cash flow that's also investing wisely is building for the long haul. A company that's burning through cash just to stay afloat, that's a different story entirely.
And now you know how to tell the difference.